Good morning. Good morning. Nice to see you guys. This is Vanessa Noble, your LCA moderator and agent in Anchorage, Alaska. Thanks for being patient with me the last few weeks. It's been a little hit and miss for me as I have been in the process of moving. And so that has been absolutely insane, as well as my son having surgery. And that was a lot. There was a lot more complications and surprises in that area also. So it's been definitely a rough few weeks, and plus managing business and deals and transactions and all of the clients. So it's been insanity, but all is well, and I'm happy to be on. Today I'm hosting solo, and I'm really excited. Patrick is on vacation because what I'm going to talk about this week is something that I really love to encourage realtors to, a perspective that I really love to encourage realtors to have with every single buyer. As you may or may not know, I lead active duty passive incomes, real estate, and realtor education side. So we have a network. If you're a veteran and if you're on this call, that means that you're focused on investments or you're interested in investments. So we take veteran, military veterans and real estate professionals who are also realtors, and we help them by helping them with leads and stuff, because our clients are service members that are learning these investment strategies. And so when I first started in real estate, it was very, very different, because I started from being an intelligence analyst in the military in a combat environment. So I literally went from being in Afghanistan in 2012 to getting starting for my real estate test in 2013. And so when I came into real estate, and I started with Keller Williams, and for those of you that are familiar with that brokerage, they had the Ignite class that was actually required at our market center. And so what ended up happening was I was watching everybody around me just cold call and, do all the realtor things and learn all the scripts. And I couldn't really get in the groove with that. I watched everybody do it, but I had just come from an environment where the weight of my word meant people died. And so when I came into real estate, and now I was going to give people advice, when just from coming from a combat environment where, if I gave someone the wrong strategy, or I gave someone the wrong information, no kidding, people would die. I mean, we had to send helicopters up in 4 minutes to rescue people on the ground, and I'm the intel person, right? So I do all the back-end analytics. I watch all the insurgent and combat traffic. So transferring from that industry, the military industry, to real estate was very hard, because when I would go into talking to people, I didn't feel like I actually had a sense of a knowledge set where I can offer somebody value or give anybody good advice. So I actually ended up learning from a mortgage broker. This mortgage broker was very, very special because I was basically single-handedly raised by him. I don't know if you're a real estate professional, unless you're on a team, there's a few qualities that you have to learn as a realtor. Number one, you learn realtor things, which is, sales skills, whether it's lead generation or whether it's marketing. You learn those two things so you can do a good job for your listings and prospect for buyers. You also learn contract negotiations, right? Which honestly, you only get good at with volume. With the more transactions you do, you learn your contract negotiation skills because the more problems you have to solve in contracts, the more buyers and sellers and properties and weird things, the more that you kind of gain a skill set to learn how to hold leverage in your contracts, and then how to foresee problems that you can avoid for the next people that you're helping, right? And so you have your realtor things, which is your marketing, and then you have your contract skills. You have your transaction process that you have to learn as a realtor. But then this fourth thing people always forget about, and it is very heavy on finance, economics, analytics, basics and, knowing your economy, but also understanding mortgage strategy. So for those of us that have come in and are, like 90% of realtors or more, I don't have actual data, but are residential focused, right? We help buyers and sellers in the acquisition or sale of residential real estate. And so learning conventional loan guidelines and strategy is so important when you're going to help people start with an investment portfolio. A lot of consumers will come into real estate and everybody has this dream that they want to create, have wealth. Right. And when you have a job, and for military service members, they have a fixed income. It's called their rank. They're not going to get a raise. They can't, and their time is owned by the military. So they can't actually go get some side job or, whatever. So when they're limited in their finances, and a lot of people who are just very static in their career progression, you kind of see it as like, what do? You go to school, you get a job, you hopefully make $100,000 in your lifetime, and they don't see that opportunity to grow their income. A lot of people have a misconception that investing is for the wealthy, right? Because why? You have to have 20% down to buy an investment property. So who the heck has that kind of money? So when I ended up learning from a mortgage broker, and there was this really weird situation with this mortgage broker, and I'm going to caveat this because it is important to the story. This mortgage broker had a pretty bad reputation. Not the person, not the LO, but the brokerage had a bad reputation in our community because there were some crazy things that happened during the crash, and there was a lot of people that were wounded and all that stuff. And I live in Anchorage, right? So it's a very, very small town, and reputation goes far fast. And so this mortgage broker, this LO, he was a partner in the brokerage, but he was not that way. He was really amazing, and he was kind of growing his book of business. So he was super smart when it came to guidelines and knowing everything and all the different strategies. And because he was a broker, he didn't just work for any type of lending institution. He shopped all the wholesale institutions. So every single client that he would take on people with bruised credit, because he was really trying to work hard at building his book of business. So he didn't just take your premium borrowers. He took my clients with 560, 580 credit scores that had to really work hard at piecing them together and working. And I mean, I've never defaulted on a buyer, ever defaulted on a buyer. We were close one time when one of my buyers did not disclose that they had child support, because it was every other year child support court order. And so the crazy thing is that he ended up just pulling that file and resubmitting it to another bank with the court order attached, and they were able to put the file through. It took a 2-week extension, but still, I've never defaulted on a buyer. This guy knew his stuff, knew every single guideline when it came to the VA loan, or especially I specialized in VA loans. So he really helped a lot of people qualify for property. Another thing that is really important to help your buyers is to not put both borrowers on the loan if you don't have to. What does that mean? That means you have to stretch their debt to income ratio. So if I could put one partner, one buyer, if I have a married couple, I only want to put the wife or the husband on the loan if I can preserve the other person's buying power. So now we're setting up people for strategic investment opportunity. Okay. And so it was really cool when I got to learn from this lender who not only was working with a buffet of wholesale lenders. So there was all sorts of different guidelines and ratios. And so I got to learn very early how to discriminate between the government guideline and the VA guideline and the lender's overlays, right? And I learned how, all the different fee structures, as well as, the interesting thing about a broker is that they're audited by the government. They cannot charge any lender origination fees. So that made them preserve person's buying power. I'm going to preserve credit. We'll touch on that. Cool. I'm just going to try to watch questions as they come in, but I'll touch on that. Maximizing your buyer's buying power. I'll tell you what that means. But really learning the difference between lender guidelines, the lender fees, making sure that I wasn't going to have any lender fees because we were in a very competitive buying environment like you are now. And so if I had a lender that was stacking, like if you're working with a retail bank lender, like if it's a credit union, I always tell my buyers anywhere that you can get a bank account. If you are working with a retail lender, you are doing your clients a disservice. And if it's because they serve you leads, then shame on you, because your fiduciary duty should be to your client always. That's why I've never gotten any leads from any type of local retail bank lender in my market, because number one, I don't need leads fed to me by lenders, but number two, like they charge extra fees, and I'm going to tell my clients the truth about where they are going to get the best deal, right? So when I package an offer, and if you're in a competitive buying environment, which everybody, this pandemic craziness has created that, then we need to make sure that when we're writing offers that we don't have $2,000 of extra closing costs to try to cover or make the buyers pay. It's going to come out at their closing table out of their pocket if it's not covered by the buyer, by the seller. So depending on where your market is, if you're not using a lender that doesn't already have no loan origination fee, you're doing your buyers a disservice. That's thousands of dollars that you could be saving your client at the closing table. And, for example, if I'm getting the seller to pay all of my closing costs for my clients, either way, that extra closing costs can go to paying their VA funding fee, or it can go to pay if they don't have a VA funding fee. There is fees with the FHA loan. If they're a conventional loan type of person, they can pay down their interest points with that extra money. Or if for a lot of lenders, they could even pay consumer debt, like they can pay off credit cards. A lot of lenders will allow that. So if you are allowing loan origination fees to be on your settlement statements, you're not doing the best job scrutinizing the lenders, or at least educating your buyers that they're paying extra fees to those lenders. Okay. So that's just one thing that I'll say. But this lender was really teaching me all of the things, because he was taking difficult people and helping them get loans. So this skill set that I learned of how to navigate mortgages in order to help my buyers use that benefit for investing was really, really huge. And in our market in Anchorage, we have a lot of residential multifamily. So I'm not talking about large scale, apartment complexes. And truthfully, anything over 5 units is considered commercial. And most residential lenders can't even touch those properties. Even if it's zoned weird, sometimes they can't even lend on those properties. But so we have a lot of multifamily in Anchorage. So that added another extra layer of investment opportunity that I got to learn as a brand new realtor. So taking the strategic picture of, okay, first, and this is my Intel analyst brain on my military intel brain on real estate, right? How can I help my clients create a strategy? Number one, when I sit down and this is every buyer consultation that I have, no kidding, I teach them investments, and I teach them all of I call them the real estate models. So when they buy a multifamily, they can buy up to a 4-door, right? And so the things that you need to know as a realtor when you're qualifying your client before you even send them to the lender is if they are interested in a multifamily, and let's say they are a civilian, not a military person, they do need their down payment. They do need reserves if they don't have, if their DTI can't cover the whole mortgage. So like if it's a $600,000 fourplex, and so that mortgage payment, is somewhere around $4,200 a month. And if they're just organic debt to income ratio, their income doesn't cover that, then they do have to have reserves. So that's one thing that they can do, is if they don't have the income level to qualify for that property size, then if they have reserves in any sort of IRAs, any sort of retirement plans, any sort of savings that are actually 6 months of that mortgage, the value of it, then they can actually, what lenders let them do is they can take the gross rents from the building, which is 3 of the gross rents, and they add that to their debt to income ratio, which typically will bring their qualification up to the value of that property. So there's ways to help people get into multifamily. And so in my market, a lot of times my clients will come to me and I help them understand that you can buy a single family home, and either you're going to buy it for lifestyle and luxury or and comfort, or you're going to buy it as an investment. And really, dream homes will always be in their sleep, will always be in their dreams if they don't set up the investment strategy to get to their dream home. And unless they're doing some crazy different career change or becoming a realtor, which a lot of our clients do, to change their income status, where are they going to change their career progression to ever get their dream home, right? So real estate investing is definitely the key to wealth building. And the way that we teach our clients that don't have a pile of money to start with commercial investing, as I love to teach, since I focus on military, I love to teach the E3, E4s that really are from underserved populations of our country. Most military service members, their families haven't even graduated high school or college. So a lot of these E3s, E4s go into the military for opportunity, and they have their VA loan. So when I teach them to take their financial, they really have a low income, and to create wealth through their VA loan, it's super, super powerful. So we'll take them from creating that strategic picture of a multifamily property, so like a fourplex, and sometimes then the following year they'll buy a duplex, and then the following year in the same market they'll buy a single family, and then all of that, the cash flow from those 2 properties will pay the mortgage on their single family. And I typically, if they're young, and their life doesn't require the lifestyle for a single family home, I typically don't recommend single family homes, especially for people that are going to be moving, because single family assets are the most risky assets. So the replay will be on, we're on YouTube and we're on Facebook. So it's live now and it'll be on there. I don't recommend single family homes when you have multifamily options for your first purchase. Some people are like, what? Like, why would I buy this giant building? And isn't it more risky? Actually, it's the contrary. Multifamily properties are diversified risk. I call it your doors to mortgage ratio. So if I have 4 families contributing to 1 mortgage, the likelihood of you not being able to pay that mortgage is 4 times lower. And so when you have a single family home and the margin, you don't have very much cash flow on that property and all you're banking on is appreciation, then you as the realtor are even more responsible to know your market analytics, because if you don't know what cycle you're in your market, if you don't know, are you in an up economy, down economy, what is the appreciation rate in your market, how many thousands of dollars is that property gaining an equity position for them to, can you put this in a portfolio for them to know how much will they earn per year in capital, in their equity position, and then over how many years, number 1, can they even sell and turn over the property, or number 2, will they be able to even cash out refi to reinvest? Because that's the goal. We want to create a nest egg in their real estate assets, so that way they can cash out refi, take the capital, and reinvest the capital. So this investment strategy is buy real estate, scoop money out, buy more real estate, scoop money out, buy more real estate. Or if you're buying multifamily where your cash flow is high, or if you're in like really good rental markets like Georgia where the property is cheap and the rental margin, the rental rates are high. There's a couple of the states in the South that really have single families that have pretty decent cash flow. then you're able to take that cash flow plus the equity position. So I always, when I illustrate this in my buyer's consult, I call it like an iceberg. You know, you have, and maybe one day, if you guys are interested, post on this video or comment. If you guys want me to do my investments buyer's consult, I can kind of host it for you guys so you can see all the illustrations that I use. And I teach diversified liability real estate models, as well as this iceberg concept. And basically what it is you have, you know, real estate is like an iceberg where you have cash flow on the top and then you have equity position that you're gaining on the bottom. That's the biggest difference between the multifamily and the single family, is the cash flow position that you have. And so everybody's investment strategy is going to be different. Patrick, if you guys have been following us, Patrick goes a lot on appreciation. He is in a different financial position, right? So he doesn't really care to invest in cash flow positive assets because that increases his tax liability, because he already has so much income coming in that he wants to fold income into real estate, right? So he's in a different position. But a lot of our buyers have limited restricted income and they want to learn real estate investing. So if you're in a market that has multifamily residential, you are in a key market to be able to help your clients start their real estate portfolio with the least amount of risk. And so basically, learning these mortgage strategies is really, really key to this. Okay, so mortgage strategy number one is understand their long-term and short-term goals. And I talked about the first one a little while ago, and I know I'm on a couple of caveats here. So number one is their long-term goal to hold the property. Okay, if they're planning on holding the property long term, then you have a lot to play with. If they're telling you that they're going to sell the property in under 5 years, then you want to educate them that they may or may not be able to really make an investment like profit off of the property. And if they're okay with that, some people are okay with that. They want to buy lifestyle, right? They want the tax benefits for 5 years and they want to buy lifestyle. So a lot of times my families that have kids or want a specific school district, etc., they'll buy in those communities, and in their life stage, investments, real estate investing is not their top priority, but they want to make a sound investment. But when you're having someone that wants to sell in the short term, number one, you have to either prepare them that if you know your market and you know it's going to upcycle, then you know that if they're a VA loan buyer, that they're going to have to pay their VA funding fee on top of the principal balance. So you have to account for that. If you're in a down market, so if you are already at the market ceiling and your market's about to go down, then I typically recommend my buyers to roll their VA funding fee into their interest rate. So especially right now that their interest rate is, considerably low, if they buy down their VA funding fee into the interest rate, then by the time they sell it, it's not on their principal balance. They're likely able to refi anyway if they had to eat a really high interest rate. So they qualify for an EARL in 6 payments regardless, which is another way you kind of can take advantage of that. But they're able to buy down their VA funding fee, and then you're in a position, helping get them in a position to resell their property if they're telling you that they intend to move in the next 5 years. So that short-term goal is very, very important, especially if you're going to be in a down market and you want to help somebody get into the right investment position. And I tell them, even if they're planning to sell the house, but then they might end up holding it, then they can refi, right? They can do an EARL. I had a couple of my clients have to do that as well because they had big appetites when they were buying in the market. They were super picky. They wanted a home that was kind of on the high end of the economic ceiling. So I say that word a lot, and I want you guys to understand that word. An economic ceiling in a property is when you buy high. So like if you know that you're buying the Gucci home in the neighborhood, or if you look at comps and like comps are 420 and you're paying 435, you're kind of at the economic ceiling of that category of property. So economic ceilings are different for apartments as they're different for single family homes. So every category of real estate is going to have an economic ceiling. So you just want to kind of be aware of that. And if you're a new agent and you don't have this data, because how do I know my data? How do I like pull up a property and I kind of say, nah, not a good deal? It's because I've sold a lot of real estate in my market. So I know my market very intimately, right? So if you're a newer agent and you're like, how do I get to know my market? Do the analytical research. As an Intel analyst, so as an Intel analyst, I had to go and research, whatever country or whatever combat environment I was going into. You can do the same thing in real estate. You actually go into look at your previous sales. You take the different categories of your single family homes, your multifamily homes, your duplexes, triplexes, fourplexes, and then you kind of pool all the prices and you figure out, where you are. Are we on an uptrend, on a downtrend? What are the sales? How many pieces of real estate sold that year? So you can look at your historical MLS data as a new agent and honestly sometimes be a lot smarter than active realtors, because even people that sell a lot of real estate in their market, some of them aren't paying attention to this stuff. They just sell homes to sell homes because it pays them a paycheck. They're not selling homes to really help people build wealth. And that's a different type of realtor. So if you're wanting to really gain knowledge and insight, number one, learn mortgage strategy, and number two, learn your market analytics. Okay. So we take that multifamily, that long-term goal, that short-term goal. Are they going to hold it? Are they going to resell it? If they're going to hold it, like I have people that tell me all the time, like, you changed my life. Because now we're looking bigger, we're thinking bigger. And real estate is a great industry where, like, how many times have we got into this industry and we get around big thinkers and minds that just think about business on a different level, and you just feel so amazed that your whole life perspective changes being an entrepreneur, a business owner, a real estate professional, and the amazing ability that we have to collectively connect with all of us, that we're just so we're amazing out of the box thinkers. And so when I teach my clients to think out of the box and to create wealth paths for themselves, streams of income, it's life changing. And so when the multifamily path is a huge opportunity for buyers to take advantage of, because they can buy up to 4 doors on an FHA loan, a VA loan, and a conventional loan. Okay. They have to intend to live in the property. That is the caveat. It is an owner occupied opportunity. So you don't want to ever encourage mortgage fraud. You don't want to, they are on a journey to acquire wealth. That means they intend to move. Okay. And why would people want to do this? Well, when people buy a fourplex and they gain a $30,000 cash flow position in their first year, which is the equivalent of some of their incomes, it's pretty advantageous. And I have a family that just closed like not even 4 days ago. They have 2 kids and they bought a triplex, and now all of their basic housing allowance for military members, or the money, if they're civilian, the money that they would be putting towards a mortgage or rent, they get to pocket it. And if they were going to be paying $2,000 a month for a mortgage, now that's $24,000 a year of opportunity cash flow that they have to pocket, right? So you teach them how to hold their, oh, of course. Yeah, you never want to encourage mortgage fraud. No. I had a client the other day that said, because this is another mortgage thing that you have to learn, okay? If they hold a piece of real estate, so let's say they already own a home, short-term pain for long-term gain, absolutely. If they already own a home, then, and this, you have to set them up for this for their second property, because the goal is, I help you buy your first one, I'm going to help you buy your second. We're going to acquire real estate. What's amazing is that, and another rabbit trail, I'll come back, I promise, is that I have people that are like retiring teachers that say, Vanessa, I have nothing to show for my 20 years of, teaching, and how can I create a retirement plan for myself in 5 years? And they're elderly. This is the plan. So whether you're a service member, a young family, a retiring person, an aging single female or a single dad, like this investment path is the way to get them into a financially free position and are just a lot more financial flexibility. So, but a mortgage fraud, it was kind of interesting. My client was qualifying for a single family home, and but when they hold a piece of real estate, they have to show a lease for the property to qualify for their next property, right? Most of you should know this. Well, the lenders can only qualify for a certain percentage of that lease. I want to say it's like 85%. I trust my lenders so much right now that I'm not even like super in the weeds with them anymore, because my lenders know exactly what they need to do for my clients and how to puzzle piece them. But it's about 85% that they can count towards their income. So like, let's say you have a property that you rent for $2,000 a month and the mortgage is $1,900, right? So you think you're positive $100 a month. Not really. You can only qualify for your DTI about 85% of it. And so you're actually red on that property from a mortgage standpoint. So whatever gap that you have on that property is added to your debt to income ratio. Like it's like a bill, like if you had a credit card for that exact payment amount. So it actually shows red on from, when your lender is qualifying you. So I had told my client, because he was like, oh, my home fell out of contract, I'll just rent it. And I said, okay, well, you have to ask the lender how much you need to rent it for in order to keep your DTI healthy so that you can qualify for this home that you're buying. That's your job as a realtor, guys, is to hear all of those financial things that are happening in your clients' lives. And so I was like, talk to the lender, you need to know how much rent or lease you need. So then he goes, and I guess she needed $2,400 a month, but the market would only bear 21. So that put him at a negative $300 a month situation, in order to clear that full mortgage. And so that $300 was going to reflect on his DTI. And so he came to me and he said, so if I were to sign a lease for $2,400 a month, but then after I buy my house, lower the rent to $2,100 a month, he's like, can you do that? And I was like, you can absolutely not commit mortgage fraud, so I'm like, I don't want to hear any of that. So you have to be aware that some of those things will come up with your clients when they're trying to overcome a lot of these, contingencies on their loans. So because when they do hold, let's say they hold a fourplex, right? Now that they hold a fourplex, now they have to have the reserves for a fourplex to buy that duplex. So I always tell my clients, look, you're going to bank $24,000 this year. Don't go on vacation. Don't buy a car. Like, we are on an investment path. Therefore, you should hold all of that income, so that way you can buy your next plan, or you're going to end up being a fourplex longer than you want to be. When they go to buy their duplex, which is a little more comfortable, you get a little more lifestyle with the duplex, because usually you're going to live in like a 3-bedroom, 2-bathroom with a shared garage and just one shared wall. But now they get to buy their duplex. And so with, a low owner occupied down payment, and then their fourplex, just put in the bank their reserves for their next property. Someone just asked, do I use lenders that use stated income? Not to my knowledge. Not to my knowledge. I'm not sure of any stated income loans, maybe besides an IRRRL on a VA loan, but no. So now they have the reserves to buy their duplex. So the fourplex will create the reserves to buy the duplex. So now they're set up for their next property, right? And what they have to save is their down payment. And so, you really want to help them lean into this financial responsibility. And then the third property can likely be a single family home in that market. Now, if they're single, or if they're a married couple without kids, or they can house hack even a single family home. So what's a house hack? That's basically just renting your rooms, right? So they set up the rooms, Airbnb them. That's super lucrative now. A lot more people are more familiar with this. This is a term that was coined by a lot of investors, called house hacking. So they can rent out their rooms and still if they're really wanting to lean forward into investments, you want to maximize that cash flow, right? Especially if you're on limited income. You're not so concerned about your tax burden, because now you are going to take some tax burdens. But guess what? Every time you acquire a new piece of real estate, you also have some tax write-offs. So it's a great ebb and flow of, now you increase your cash flow, you increase your write-off, right? So this is for people that really want to lean into these owner occupied low capital investment opportunities, because now that you set your clients up for having a savings, learning how to manage their money, living beneath their means, so that it's a 3 to 5 year plan that can help them. I mean, this is amazing for single moms or single dads that don't want to have to depend on a relationship to create more income and comfortable lifestyle. Because let's face it, that's why people end up in relationships, is to have a second income in their home, and they settle for that because of that. So when you set people up to be financially independent and financially free by going through investment strategies, then you really empower them to just live so much more of a free life in general. So, you know, when I really believe in educating people for financial freedom, because you take people from surviving to thriving, and when they get into thriving, now they can get into giving. And when people, you know, giving and being more generous and abundant, and that's how you empower people to really push positive things forward. And so this real estate investing opportunity for me, and teaching clients and other real estate professionals to re-educate your clients in your market how to do this, is more to do with just, you know, increasing your wealth potential and increasing, you know, your financial status. And what, I mean, we're not taking, I mean, coronavirus is a perfect opportunity for you guys to realize that nothing really freaking matters. We're not taking our money with us. You know, this is about being able to do more good and having just more freedom in our financial choices by being wise with our finances, buying conservative. So what if you're not in a multifamily market? Right? What if you're in a single family market? What do I do? So teaching house hacking is really, really good. Teaching buying, so the mortgage strategy of, I call this justification, and I talk about this in my buyer's consultation as well. So justification is a very important term when it comes to mortgages. If you have to justify why you are buying your next property in your market radius. So if they're service members, military members, we kind of get lucky because we get relocated. And when we get relocated, we actually have a new reason to buy another piece of real estate in another market. And so we re-qualify for low capital owner occupied loans, right? But if you're not a military member and you're not moving from county to county to county, because let's be real, like, it's not fun to relocate your kids to school, but you still want to like buy real estate in your just local city, then you focus on justification. The first property you buy is an apartment, maybe a 3-bedroom one, right? That has no garages, because the next thing you're going to buy is a condo with maybe a 2-bedroom with garages, because now you can justify to the lender in 9 months that that house is not comfortable for you. Now you want a garage. And so in 9 months, when you start shopping and qualifying for a second piece of real estate that's owner occupied, now you go from an apartment to a condo to a single family home, maybe that has a carport, not a garage, and then you can buy another single family home. You also want to help them buy property that makes sense in the rental market. So you have to know your rental market to be able to say, can you feasibly rent this in a healthy market? I look at the demographic of the market. So since I focus on service members and military markets, I look at the E4, E5. What is that? That's just a rank. So that's typically the blue collar part of the military and the most demographic of renters. But when you look at your rental market in your community, find the niche. Is there a school? Is there something like who are the renters in your market? And you want to help your buyers find the niche in that market for renting, because now you're going to help your clients hold real estate, right? So now they're going to find a renter. You want to help them find a property where they can make, sometimes it's going to be a fixer if you guys have a tight market. So you have to help them with understanding how much, and I'll go to questions in a minute, how much ARV they're going to have if they improve. You want to find things that are just going to require some paint, some countertops, something that beautifies the property in that neighborhood. They also want to buy homes in renters neighborhoods, so you want to be pay attention to that in your market, so that way they can buy a really good rental property. Like my first rental property, my fourplex, what I did was I beautified that property because I found a fixer on a lake. And I was like, I can create high-end living on a lake just by putting a backsplash, painting the walls and putting nice countertops. And all of a sudden, all the renters, I never have vacancy in my units, because renters know that they get very vanilla type of properties. And if I throw a backsplash on it, and, make it pretty, renters really, really gravitate to my units. So you want to have that kind of that little like, okay, what are the low cost things that make your rental more marketable in this market and will help them get that extra $150? Truthfully, if they have less than 4 doors, 5 doors, they really don't need a property manager. I encourage my clients to go to cozy.co. It's COZY.co, and they can manage, they can accept payments, they can run background checks, all on that. It actually syndicates directly to realtor.com. And guess then what I tell them, that I will go ahead and market their rental on the MLS you could charge them $400. Or if you want to do it for free, whatever your business can bear, whatever your admin cost is. But, I require that they do professional photography in their rentals, because I don't want any of my listings looking, rough. And so I require that they do professional photography, and then I will throw their rental on the MLS so they get more exposure. And I give a $200 like buyer agent or leasing agent fee. So you want to make that so that that they're going to be lucrative in the market. And so your buyers love you for just putting their rental on the MLS, and so, because I don't do property management, that's one thing I will not do, but I empower them to learn how to manage their assets. And, when they have 1 to 4 doors or 1 to 6 doors, and I tell my clients under 12 doors, you can self-manage it unless you're a fighter pilot, which means you're locked in a jet, or unless you're like an Intel analyst like me, but I'm not a full-time service member. But in an Intel skiff, I cannot get to my home for an emergency. But I always tell people, whenever I have a plumbing leak in my fourplex, I don't run to go fix it. I call a plumber. And now when my property has, a cash flow and a reserve account, and it's paying its own machine, all of these properties create their own income. It's not taking the money from the food off my table. People are scared of a plumber bill because they're scared of it coming out of their actual W-2 job. But when these investment assets create their own wealth portfolio for your clients, and you have to pay a $250 emergency plumber fee, and I just made $2,000 off of, on my net sheet for that month off of my real estate assets, I'm not crying, right? Because that didn't even come out of my W-2 job. So when you teach people to call a plumber, or to tell their tenants to call a plumber, it becomes very easy. It's just about empowering your clients to think outside of the box and not be limited by their beliefs that things are hard when they're not. And so when you start these investment, if you want to focus on investors, start an investment club. If there's not already one in your community, start one. We have, if you're a service member, we have active duty passive income. We have a 12,000 member military real estate investor. And what I love about encouraging my clients to jump into that is that they see that everybody's doing it. And it's not hard. And I tell my Army guys all the time, when you first jumped out of a plane, it was scary. And then now you have like 500 jumps under your belt and you're not scared. When you first buy an investment property, it feels scary, but it's not. And when you see everybody doing it, it's super easy. Calling a plumber, not scary, So we just teach them how to self-manage. Then once they have enough property where the burden of answering phone calls, which honestly most tenants, if you maintain your property well, you really don't have a lot of crazy calls if you just do your annual property maintenance, right? So I get 1 turnover a year and maybe 8 total calls for $24,000. Go find a job that's going to make you $24,000 for the burden of a couple phone calls a month. Okay, and so when you break it down to what is really the burden and what is really the benefit, it just makes sense for people to do that. My tenant right now just asked me, one of my tenants asked me, Vanessa, can I see the lease? And I just said, why, are you thinking of moving? And she said, well, we're thinking of buying a house. I said, great. I can absolutely be flexible for you to buy a house. Let me teach you how to invest. And my renters, they are like so grateful because I'm like, great. As long as you get me through the winter, I can give you a flexible lease after February, which means we can write a contract in January, and then you can close in March. And, you know, and there, I mean, my buyers are my tenants all the time. You know, so it's really, really beautiful when you teach your clients how to do this. And let me run to some questions here because I think we are getting close to the top of the hour, and we are. So Q&A, they can use the VA for investment. So absolutely, owner-occupied investment properties. This is my niche. This is what I teach service members to do. I teach them wealth building strategies because there's no more deserving person to earn a dime off of this land that we live on than those that lay their lives down for it. And they can use their VA loan to learn how to invest. They can have up to 4 properties on one entitlement, depending on the loan limits and the cost of their previous properties. So like if my clients bought a really cheap home in Fayetteville, North Carolina, and then they go to Alaska, they could buy like 2 more because their loan limits increase. And I know I had a couple of things in the chat box. Let's see here. So short-term and long-term goals, I wanted to finish on that, you know, just helping them put things into perspective. Oh, my 4 categories for short-term and long-term goals is they're either gonna hold it long-term, so single family hold, multifamily hold, or they're gonna flip it. You could actually flip a conventional loan home. If they buy a distressed home and they're going to fix it themselves, they can take 6 months to fix it and then plan to resell it if they have the ARV and margin to. You know, lenders will not be happy with you if they haven't made 6 mortgage payments. So they want to make 6 mortgage payments. So that's usually about month 9. And so usually people that are owner occupied flipping it and have a W-2 job are going to take about 6 to 9 months to rehab a home anyway. And so then at the end of the year, they make their margin, you discount your listing so that they can, and then they'll buy from you again, right? So when they buy on your acquisition, just like you would any investor. Any investor that I know is going to be a repeat buyer seller, I discount my listing because I am their person, right? So we acquire, we list, we acquire, we list, and that is how that works. So for short term, it's they're going to buy lifestyle and luxury, so they're really not going to make a buck. You want to watch their VA funding fee and make sure they can sell if they're in a down cycle, or watch any of their overhead costs that they're adding to their principal balance. Or if you're on an up market, then you know that they're going to appreciate, they're going to be able to sell in 4 years, and you want to really cultivate that. Prepare them for a rental always in the event the market does something you don't predict and they have to rent it. Make sure that you always have that idea in their mind that if you have to rent, this is the strategy for your type of home. Okay. Because they will come back to lean on you about what to do for their rental, what should improvements. My clients come back and ask me recommendation questions all the time to improve value for their home. And that just helps me not have to call them to say, hi, how are you doing this month? Because they're calling me to ask me for advice. And so it just facilitates that investment conversation with them. I'm trying to see chats. Okay, great. I couldn't find that for a minute, sorry. Another thing, so those are your 2 short-term goals: buy and sell, buy and flip. Long-term goals: buy and hold single family, buy and hold multifamily. What is your opinion about out-of-state landlords? Would you still suggest self-management? So that depends on how their W-2 job imposes on their time. I can self-manage. It doesn't matter if I'm 20 minutes away or I'm 2 time zones away. By the way, cozy.co has a way that they can put in an email maintenance request. So it's super cool for you to manage your property and not have to worry about it. The biggest thing that you have to do that's hard, that is burdensome, is turnover, right? So when you have tenant turnover, doing your checklists and doing your doing a checklist and then doing a walkthrough. And hello, you can hire somebody to do that. Any maintenance person will do a walkthrough. Like if you have a handyman and you're like, hi, will you take keys from my tenant and take pictures? And there you go. And I'm going to DocuSign a lease to them. you can Zoom call an interview for your tenant. You know, the walkthrough will have to be done by a showing agent in most markets. But, you know, there's ways to self-manage. So it just depends on how much margin you're making. If the property management companies are taking 10% to just collect rent, and then they hold their rent, that's a danger that I always tell people about. If they hold their rent and they have a maintenance emergency and your clients are tight on their finances, a lot of times the property management will pay the maintenance bill and not give the landlord the money to pay their mortgage. And I've run into that on a multifamily seller, and I almost lost my shit with a property management company. I also recently had a property management company that my client told them they wanted to list it in this really good market, and they wanted to list it for sale and rent concurrently. And then that freaking landlord signed a lease before we went live on the market. And I almost lost my shit. We had just, excuse my language, we had just painted and put brand new carpets, and we were doing photos, and they signed a lease on the same day. I almost lost my mind. So, and because, you know, we are in a pretty high capitalizing position for sellers right now to be able to scoop out a really good nest egg. We're in a high appreciation point for a lot of them, with the low interest rates really creates that appreciation ceiling for sellers. And the problem is that the next cycle, they're probably going to make about $10,000 less, because buying power is going to shift. If the interest rates go up 1%, that's about a $10,000 reduction in purchase power that buyers will have, which is going to shift over to what sellers are able to sell for. So you'd be surprised. Right now, sellers have such a very unique opportunity to take advantage of selling and increasing their margin to be able to scoop out that nest egg. If you sell a property less than you bought it for, can you use depreciation as a tax write-off? That's a tax question that is not something that I know, so we'd have to defer that one. I know, I don't know. You know, my thought immediately, though, if I had to use deductive reasoning, is if you have an LLC and that is already on a K1, it's your investment property, and you are taking a loss and you're set up like a business and not just a sole proprietor type of owner, it would make sense to me that your losses on your business can be written off. But that would definitely be a tax advisor question. Anything else? I think let's see. Yep. Okay, if there's no more questions, we are at the top of the hour here. Next week, Patrick will be back. Oh, and by the way, we're going to do our 2-hour, sorry, it's really smoky where I'm at, so I'm like sniffly because I'm in Northern California right now, and the smoke is really, really bad here. But in 2 weeks, pay attention. Tristan, LabCoatAgents, is going to push out an invitation for our 2-hour tax class with Patrick. It is a paid course. We're still working on the website for it. So if you really want to know the tax strategies and get the tax forms, etc., we're gonna have kind of an entry level paid course that's just the class, and then we're gonna sell his package, which is all of his spreadsheets and everything, for an increased cost, and then a mastermind with him on taxes. So that will be in 3 weeks, actually. So we are looking at, so instead of this class, we're gonna have the paid class. And it's going to be same time on October 1st. So keep an eye out for that. Okay. We're really excited about it because Patrick is just such a wealth of knowledge, and I'm excited to bring all the tax stuff that we all love to know but hate to learn, or love to learn but hate to read, whatever you want to say. All right, guys, I hope you guys have an amazing day. We'll see you next week. And if you have any needs in Alaska, or if I can help you in any other way, shape, or form, don't hesitate to reach out. You can reach me at Vanessa at activedutypassiveincome.com. Bye, guys.